It was a year ago today that the Fed started raising interest rates for the first time since 2015. After 8 hikes, the target rate is at its highest in 15 years. But the latest turmoil in the banking industry has some thinking the central bank may be ready to pause. Hear what big short trader Steve Eisman said to us last night on the decision the Fed has to make.
The Fed won't be raising rates because it's scared. Well, if the Fed is scared, you should be scared. You know, on the other hand, if the Fed raises rates even in the face of this by 25 basis points and says that we still could raise more, then that's like, wait a minute, you're sort of caught between a rock and a hard place. Financial conditions have really tightened, but you still have inflation. It's not clear either move is good.
Let's get more on the Fed's next move with David Rosenberg, founder and president of Rosenberg Research. David, do you agree with Steve in that it's sort of it's a pickle? I mean, I don't know if either is a good choice here.
Well, remember that it was just over a week ago that Jay Powell was nurturing the market into believing that we're going to have 50 basis points. I think right now the Fed is probably going to do what the markets have got priced in, and that changes by the day. So let's assume that things in the financial markets and the banking system can stabilize in the next week. They're probably going to go 25 basis points. They're not going 50. I think they should do nothing, and I was saying that after the Bank of Canada did nothing after their last meeting. And you could argue that Christine Lagarde sort of, with her 50 basis points today, sort of gave the green light for the Fed to do something. And I think the Fed wants to do something. I think that they want to signal to the market, even in this turmoil, that they haven't taken their eye off the inflation ball. But 25 basis points here or there. I mean, look at what financial conditions have done just over the course of the past few weeks. They've tightened dramatically. And I think that's altered the equation for the Fed after this meeting. The more important question isn't whether they could do 25 or nothing next week. It's really what's the end game. And so I think that if you're going to ask me that question, I think the end game is next week, no matter what.
It's interesting, David, because you look at the housing numbers that came out, the job market is still, as tight as it's been in quite some time. And I'm one of these people that doesn't think they can thread this needle. But all the things on the ground suggest their job continues to get more and more difficult. So if they say 25 and done, in my opinion, just opens the floodgates for asset prices to go higher, go off to the races, the housing markets, all the things they've been trying to combat, that genie's going to be out of the bottle one more time. Am I accurate in that assessment?
Well, I think the circumstances have changed. So I'm not so sure that there's going to be this ballyhooed Fed put in an environment where there's so much uncertainty regarding the banking system. And we know the big banks, they're fine. This is not 08, 09. But there are big problems in the small and regional banks. This game is not over. And we've already had a significant tightening in financial conditions. And as far as the stock market's concerned, how far is it going to go? I mean, earnings and earnings estimates are coming down very notably. And in fact, we're heading into a 5-quarter recession in earnings. So I don't know, we're 15 months into a bear market. The S&P is down 18%. So we're going to get excited because there might be a short-term trade based on a Fed pause. I mean, that's really playing small ball. We haven't seen the full impacts. You're quite right. The jobless claim numbers are very low. Companies are still not firing. But if you look at the survey data, they're not hiring either. The claims numbers don't tell you what companies are doing about hiring. It just says what they're doing about firing. So, yeah, they're not firing people. I mean, they are, of course, in the headline numbers and some of the financials and technology. But the claims numbers are the claims numbers, and they're telling you about pink slips. But I don't think anybody's doing any hiring. So I think the claims numbers could still be consistent with a flat employment profile. Now, look, we got a very important number today, right? We got the Philly Fed Index, which came in at -23. It's at a recession level. When you look at the components, it's showing that the ISM is going down to, I mean, the ISM equivalent in the Philly Fed today. I didn't see this all day long. I watched CNBC all day long. Nobody mentioned the fact that the ISM equivalent from the Philly Fed is 39. 39. So claims aside and all the other stuff, housing, which was all multifamily, it was not a single family story. It was a multifamily story. And that's good news because it means we're going to be flooded with rental construction in the next year that's going to take care of the rental inflation and the CPI. But I'd say the Philly Fed, the Philly Fed today got no press, and the last 2 months, huh?
Well, thank you for making the point, David. We appreciate that's why we have folks like you on. But I wanted to ask you one last quick question, and that is, does this, what happened in the past week or so, what the Fed might do next week, does any of this change your outlook for the economy in terms of a recession, how long it may last, how deep it may be?
Well, it's reinforced the recession call because we've had a dramatic tightening of financial conditions. And what's going to come out of this, it's not a 0809. So I'll put my positive hat on. But it's going to reinforce what's already been happening before this crisis, which is a tightening in lending guidelines. So we're going to go through a credit contraction. We have an economy that is driven by credit. And so I think that is going to be problematic for the economy, is the fact that banks are now going to be much more focused on shoring up their balance sheets than they are in terms of extending loans to the private sector. Right. So I think that's what comes out of this, actually. Everything we've seen in the past couple of weeks brings the recession that much closer. Hard to know how deep or long it's going to be at this point. And I think that's one of the reasons, look, the Bank of Canada heads up, the 51st state up here in Canada. We're the 51st state, but we have good donuts and we have great beer. And they've already gone on hold. And I think the Fed is going to be next. And don't forget, the economy resets with a lag to interest rates. We have not seen the full brunt of what's already happened. So, yeah, I think the recession starting, I'd say, I'm not going to pinpoint it to the month or the quarter, but Q2, Q3 has a bullseye on its forehead.
David, always great to get your take. Thank you. David Rosenberg, Rosenberg Research. Karen, what do you think?
Was he coming to us from Canada?
Canada.
I didn't know that. I didn't know that. I'm curious. I mean, I don't know if it really matters what the Fed does, 25-0. I mean, 50's kind of, I think, off the table. It's how quickly will we see the effects that David's talking about of this credit contraction, and will that finally get inflation to where the Fed can actually say we're pausing, or maybe we're even done?
Yeah, I mean, we've seen the reaction already in commercial real estate, in REITs. In particular, office REITs, Tim, and I guess that goes to the notion of these regionals were very active in lending to these sorts of projects. That's where they got a lot of the funding. So we're seeing in pockets of the market already this notion that lending will be restrained going forward.
It's right. So commercial real estate, now everybody's looking at that. And, all the cliches that are out there, perfect storm, et cetera. I mean, it's nice to hear a guy like David, who I think is appropriately and, kind of thoughtfully skeptical, and always is, say it's not 08, 09. And so on some level, taking it back to credit and taking it back to contagion into housing, I think, you have to think about some of these things. The last couple of days, the market treated the events as if we were heading into an 08, 09 kind of a dynamic. Clearly, at least in the short run, we are not. We haven't seen that kind of blowout in broader credit spreads. But it gets back to the market. Certain subsectors are trading like we have a deep recession coming. And I think that's the place for investors. There's huge opportunities in stock picking in here.